Just double. Oh, there we go. Look at that. Okay, let's see if I can. I'm not gonna use that. I'm gonna use the nose thing. There we go. That works. Okay, we got it. Yeah, we got it to our bill. Hi, everybody. My name is Talitha Parsons. I am the owner and founder of Gingerstat Bookkeeping, based in the Methow Valley. I actually live in Twist, but I work from home. I grew up in the Methow Valley with hippie parents. If you guys were here for the last one, you know all this, but I'm repeating it for the new people. I wanted to, in high school, I wanted to be, get my CPA, go to college, get my CPA, and be the CFO of a Fortune 500 company. I had big goals. That did not happen because life just goes different directions than we anticipate it will, right? But I did own my first business at 19. I've always been interested in this. I love this field. I'm a massive numbers nerd. I am a little on the sweary side. Those of you who are here before, you've been warned. Those of you who are new, just so you know, I'll do my best, but no promises. So I'm just going to jump into it because we do have a lot of what I consider really fun stuff. The last time we talked about some basics of bookkeeping, how to structure, how to categorize, just kind of the overview of it. And this is, for me, the fun part. Yes, I know I'm weird. Please indulge me. So I love this. I get to play with numbers. Financial statements, the basic financial statements that come out of good bookkeeping, give you all of the information that you need for making every single business decision you make. And honestly, every single decision you make in a business is a financial decision. Otherwise, it's just a hobby. You're just doing it for fun. And some of it is fun. I love what I get to do, but I do this because I earn a living doing it, right? So we want that. There are 3 basic financial statements that we're going to go over today. These are not the only 3 that exist, but these are the primary ones that are going to tell us everything we need to know about the business. Those are the income statement, which is commonly referred to as a profit and loss. Those of us in the industry have a little bit of a pet peeve with that because you cannot have both a profit and a loss. It is really the other, right? So it is an income statement. Whether your income is positive or negative depends, right? The second one is the balance sheet. And then the last one is the statement of cash flows. And none of these statements is going to give you a complete picture of your business on its own. You absolutely need all 3, and I'll talk to you about why. So let's just jump in, right? We're going to go right into it. The income statement, the profit and loss. This is probably the most familiar one, right? This is the basic one. Pretty much any business owner or anybody in business is going to be familiar with the income statement, right? It answers the simple question: is this business profitable? Do we have a? Oh, sorry. No, it's all good. Mine does the same thing. So is the business profitable? This is the bottom line, right? Is the business making money or is it losing money? Very simple question. The challenge is there's a lot of things that happen in our business and the finances that don't get reflected on the income statement. So we need more information than this. However, this is what we're going to start with. So the simplest way, income is going to be at the top. This is the money that we made, right? We talked about this a little bit last time, so I'll do a little bit of review. Income is separated into categories, mostly for the business owner's benefit. This one is very, very simple. We're going to start with really simple and then get more complex later, but just to give you an overview. So this one just says sales. As a business owner, well, for taxes, that's going to be good enough, right? So if you're reporting on your taxes, this was my income. This is how much sales I have. The IRS does not care what you sold, just that you report all of it. Right? But as a business owner, you may want to separate this into categories. What is making the most money for me? And then as we separate the sales into categories, we can also separate the expenses into categories so that we can compare. This is making the most money. This is making the least money. Where can I focus, right? So that's how this can be really helpful for us. These also need to be set up, and we're in a sales tax state, so a lot of times you'll see the very basic separation here is taxable items versus non-taxable items. Okay, that's another one. The cost of goods sold is a direct expense for doing business. If you're selling a product, this is very easy to see, right? I buy the product, that's a cost of the good that I then resell. If in my business, for example, I don't sell products, I sell services, but I also have cost of goods sold in the software that's required in order to do the work that I do. That's a cost of goods sold. If I am outsourcing like a 5-year cleanup that I don't have time to do on my own, but I'm outsourcing that to another kick-ass bookkeeper, that's going to be a direct cost of the service that I'm selling, because I cannot do that work without that expense. That's why that cost of goods sold is at the top in that income section or revenue section, okay? Next come your operating expenses, and these are the costs that are directly associated with running your business, okay? So you have to have a space to operate, you've got rent. You have to pay your staff in order to operate, you have rent. Or I'm sorry, salaries and wages. You're gonna advertise, you know, these are the things that are not directly related to the sale that you're making, but they are very much the operation of your business. Insurance would go in this category, and there's a lot of nuance according to industry, right? So, yeah, go ahead.
So it feels like it's there could be things that are kind of a gray area with cost of goods sold and the operating expenses.
Totally true.
Okay, how would you differentiate which one is which?
Depends on the industry. A lot of times, can you give me an example or?
I can't think of one off the top of my head.
Okay,
but
yeah. So yeah, I mean, yeah, there are. Here's a good example I have.
okay.
So when you are processing credit cards as part of your business, those service fees, that 3% or whatever, if you're not passing that on to the customer, which we are allowed to do in Washington State, not all states allow that, be aware of that, but since we're based in Washington, they do. Some people will call that a cost of goods sold, a necessary expense, because in today's world, you kind of have to take credit cards, right? Debit cards can fall under the same category if they're run as a credit card. So that could be a cost of goods sold, or it could be an operating expense. I mean, but some things are kind of a gray area. Some things could go in one place or the other. When you file your taxes, your cost of goods sold is just going to show up as an expense. So this is a distinction that's more about the business owner's need to see clear financials. Okay, so that comes down to how do you want to see it in your books? What do you consider an absolutely necessary expense? There is some fun metrics that we can do. Oh, let me finish this section first. Okay, so then that's our operating expenses directly related to the business that you're doing. And then we have other income and expenses on the bottom. These are financial impacts. They're not directly related to the course of business. So say, for example, you're paying an interest expense. You got a loan to buy an asset or whatever to build the business. That interest is not necessarily a direct expense of operating your business, right? Credit card rewards. You use a credit card that has rewards in your business. I have one of those, and oftentimes I will take those rewards and apply them to the balance of the credit card. That would be, it's not operating. I don't have to do that to run my business, but it affects my bottom line. So that kind of stuff. Gain on sale of investments. Think of investments as assets. So say, for example, you as a business, you sell some assets and you make money on that sale. That's not a direct result of operating your business, but it still impacts, the profitability. So that's what that other income and expenses, it's going to be the smallest part of it. That's not going to be much of a concern for most businesses. This is really helpful in figuring out things. I should have gotten a calculator. I grab my phone. And then calculator out there. Maybe not right now, but. So looking at things like labor is one of the most expensive things that we have as businesses, right? And depending on the industry, it can really have an impact. Some industries have a very small labor percentage, some have a very high labor percentage. What is that percentage? Salaries and wages, 120,000 divided by total sales, 150,000. That's as a percentage of total sales. You could also look at it as a percentage of gross profit, right? What's my salaries and wages as a percentage of gross profit? And this is where industry nuance comes into play. Because as I said, some industries have a really high cost of labor as a percentage, some have really low. It depends on the industry and what you're doing. But that is just one example. If you want to look at, how much am I spending in advertising to get this much sales, you can do the same kind of a thing, right? So we're going to take that total cost of advertising divided by the sales or the gross profit, whatever metric you decide to use. The only thing is to keep that consistent every time you're running that metric. So if you do that for the month of November and you use sales, total sales to get your percentage, then in December, when you run that metric again to see how you're doing month over month, use the same gross sales as a percentage of gross sales. Don't switch it up to gross profit.
Why would you use one versus the other?
It depends on what you want to see. Again, this is all about, so as a percentage of gross sales, it's like, it's a more obscure, it's like a broader number, right? If you're just looking at like, look, I'm not gonna have those, I would do it a gross profit, not gross sales. That's my personal preference. Because that cost of goods sold, I wouldn't have those sales if it wasn't for the cost of goods sold. That is the first thing that comes out. And then whatever's left in that gross profit is what I would use. Some people like to do it differently. I'll give you my recommendation. So that's how I would do it. Some people like to do it differently, I guess is what I'm gonna say. There's so much, when we're talking about the financial statements and how we're coming up with these numbers, a lot of it has to do with individual industries. So a lot of the information I'm gonna give you today is gonna be necessarily broad. And I'm happy to answer questions for your individual industry as much as I know about that industry, but there is some research that you may want to do on your own outside of this to see what is most specific to the industry. Okay. So the other thing I'm going to talk about is this is relevant to every single report. There's two ways to interpret reports. One is horizontal, or one is vertical, which we just did from top to bottom, right? And that's really easy to see. We're just looking at what is our net income for the time frame that we're using. There's no dates on this one because it's an overly simplified sample, but I recommend running financial statements every single month. Once you finish a month, and what by finish, as bookkeepers and accountants, we say you close the month. And that means that I've made sure that every single transaction for the month of, let's say, October, has been entered into bookkeeping software. Everything is correct. It's categorized the way it's supposed to be. And I've reconciled all my bank and credit card accounts. So I know I didn't miss anything, right? That's my final step. Once I've done that, then I can run my financial reports and I'm going to do a comparison of saying, okay, how did October look versus September? How did October of 23 look versus October of 22? And so the vertical is just from top to bottom, right? The horizontal is month over month, year over year, comparing this time frame this year to this time frame last year. I talk about year over year because specific to our area, we are a very, very seasonal place. And so if you're comparing September to October, August to September to October, you're going to see a huge variance that isn't necessarily talking about your industry. It's just talking about, or how healthy your business is. It's talking about there's less people here because it's cold or it's getting cold, right? And so that's where the comparing, to last year, if you compare October of 23 to October 22, that's going to be a more accurate metric than say the summer to the fall to our shoulder seasons. So that's why we use that. All right, so trends and growth patterns over time. When we're doing that horizontal analysis of one time period to the next, we're looking at what is the trend and some of these metrics. So that's why I'm saying if you're looking at salaries and wages, what percentage that is of your gross profit, is that about the same percentage every month, even though the total volume of sales has changed? Because that seasonality will, there will be the ebbs and flows, but your labor percentage should be in the same ballpark, right? And so if your labor percentage is staying way up here and your sales came down and now all of a sudden you're spending 50% on labor instead of 30%, then maybe people cut hours. You're spending a lot of money on this, right? And so that's the way to keep tracking over that and to make decisions based on where your business is at. This stuff, I think most people are pretty familiar with this part of financial statements, right? I think most of you probably have some familiarity with this. One of the biggest mistakes that I see is business owners thinking that this is the totality of their business. They're like, oh, look, net income is positive, it's green, it's pretty, I'm happy, I'm winning. Maybe. But what's one big thing that if you have, okay, so I know that there's some of you that are not necessarily, but for a sole proprietorship or a single member LLC, which I think most small businesses are, what is one thing, giant thing that's missing from the income statement? Does anyone know? Owner's contract, owner's distributions. Are you paying yourself? But that's kind of the point of having a business, is to earn a living, so you gotta pay yourself. Owner's distributions are never gonna show up on a profit and loss because that is not about whether or not you're profitable. You're taking profits out of your business. That comes after the net income line, right? Because you're like, I made $187,000 this year, I get to pay myself, but that comes, you know, somewhere further down. And so that's why we move on to the balance sheet. Okay. The balance sheet is a snapshot of a business's financial situation at a given point in time. Okay. And it is cumulative for the fiscal period, which is typically a calendar year, but some people calendar year, January through December is typically the fiscal period, the period on which you run your finances. I have seen, and this is more common in nonprofits, to do like a June through May, right? Or a July through June. They split that and then have their different, and then they have different tax dates based on that. That gets more complicated. We're just going to go with calendar year, right? So when I say cumulative, that means that if I run this report and I put the parameters in the reporting software that I only want to see October 1st through October 31st, 2023, it's still going to pull back from January 1st. January 1st is the first date of the period, and everything up until that date is going to be included on that. Actually, everything for the entire history of your business is going to be included on this, but it should be included. Everything prior to the current calendar fiscal year should be included in retained earnings. Okay, we'll go over it in a little more detail. So this is a detailed picture of the accounting equation that we went over in the one-on-one workshop. So the accounting equation is your assets equals your equity minus your liability, or assets plus liabilities equals equity. There's different ways to put that, but essentially on here is your assets and then your liabilities plus equity should balance. So total assets at the top, cash and cash equivalents, that's like your bank accounts, inventory, the value of the stock you have, accounts receivable, that's the amount of money that people owe you. And then property, plant, and equipment, that's again assets, but those are more long-term assets than inventory. So your total assets is $480,000. Liabilities, accounts payable, that's how much you owe other people. And those are short-term. So accounts receivable and accounts payable are short-term owing and being owed. Notes payable are long-term. Okay, so when I talk about short-term, it's less than a year. Long-term is more than a year. That's kind of the basic. There's some nuance to that, but that's the basic way that we count that. So you owe a total of $290,000. Equity, and this is for a corporation, common stock. That's how much stock you have, right? Which for an owner is going to be owner's equity, right? Instead of common stock, that's your equity in the business. Retained earnings is essentially cash that you had left at the end of last year, the last fiscal period that you're carrying into this new one. And so that's a total of 190,000. So if you add up your liabilities, you owe 290,000 plus the equity, 190, you have 180,000. Balances, it's exactly the same number. A balance sheet should always balance, and your bookkeeping software is designed to help this occur. It is very, very rare that I see a balance sheet that's out of balance. It can happen, but it usually won't with bookkeeping software. If there's an error, it's going to be somewhere else that we'll find it. We'll see it in the income statement, we'll see it in the statement of cash flow, something like that, but this is always going to balance. When I talked about double entry accounting in the bookkeeping 201, this is what I talked about. If you make a change to one part of the balance sheet, you also have to make a change to the other part. So every single transaction is going to affect two parts of the balance sheet to keep it in balance at all times. Okay. So the balance sheet has some really, let's talk about the one on the right. Here's our comparison. Okay, so vertical comparison, top to bottom, everything matches, we're happy. Horizontal comparison on the right is December 31st, 2013. It's a little old. These came out of a book that I picked up at the library. I recommended the book in the last one. I'll see if I can get that emailed out to you, that recommendation. There were 3 books I recommended, and this was in one of them. But this is a snapshot of, as of the end of the year in 2012, the business had 365,000 in assets and 296,000 in liabilities, leaving 69,000 in equity. As of 2013, there was 70,000 in assets, so we have an increase of 100%. That's fantastic. Total assets is going to be 400,000 because our non-current or long-term assets, right? We still own the same buildings and property that we did last year. And then our liabilities is down a little bit, right? We went down to 32 and then 250. So we're paying off our loans. That's what we can see on that. When our liabilities, when that number goes down, it means we paid someone. That's good news. We want to decrease our debts, right? And that means that our total equity went up. So this snapshot, I can look at this balance sheet and say that this business is going in a good direction. Does that make sense? Does anyone have questions about why that might be or how we kind of figured that out on that? I mean, and that's, like I said, it's a very simplified view of things, but this is how, when you submit like an income statement and a balance sheet to get a loan, or if you're trying to sell your business, this is how people can look at your business and go, oh, well, you're obviously responsible for paying off your debts, where we're comfortable giving you another loan. Or, you know, like, yeah, I'm gonna buy this business, it's kicking butt, right? So this is a very, very important piece of that picture because it shows that trend at the time. Okay, so let's look at playing with some math with this. I might ask. I mean, I can use the one on my phone. Yeah, totally. Okay. All right, so there are some ways that we as business owners and bankers, and it's fine, don't worry about it, people who are looking at our business for one reason or another can see how we're doing, right? And one of them is called the current ratio, and that's figured out on the balance sheet. So our current ratio is the current assets divided by the current liabilities. How much do you own versus how much do you owe? What is that ratio? So we're going to look at our current assets. Let's look at the one on the right because it has a nice separation of current versus non-current assets, right? And we're just going to look at the current ratio. So let's look at December 31st, 2013. So current assets is $70,000. And we're going to divide that by our current liabilities, which is $32,000, to come up with our ratio. And the ratio there is 2.2. And so essentially we own twice as much as we owe. And that's current assets. So current talks about liquidity. How easily can I convert this into cash? And what this tells us, the higher the ratio, the more that we own in current current liquid assets versus how much we owe in current, like, short-term liabilities, that talks to our ability to meet those obligations. Can we pay that? Because if I only had, say those numbers were flipped and I only had $32,000 in current cash on hand and I owed $70,000, if those people came to me tomorrow and said, pay me my money, I can't do it. And that means that my business is not a good risk for banker or to take, right? It's in trouble. There's some issues. So what we're looking for is a ratio of 1.5 or higher here. A ratio of 1 means it's equal. Like I could pay all of the liabilities if they came to me tomorrow and said, I want my money, I could pay it and I'd have 0 cash left. Nothing. If I have a ratio of 1.5, I can pay all of it and still have some money left. And that's what we want to see is that, yeah, I can pay all those bills tomorrow and I still have money in my bank account. I'm not down to 0 because if I'm at 0, then when the electric bill comes due, you know. I talk about this a lot as personal, like I personify the company because I feel like sometimes it makes it easier to understand. So, all right, so that's one equation that we could do there. Did everyone get that equation? Current assets divided by current liabilities equals current ratio. The ideal is 1.5 or higher. It could vary by industry. Again, everything could vary by industry, but that's the ballpark.
Current assets divided by current liabilities
Equals current ratio. Okay. And we want a 1.5 or higher. Okay. Now we have a quick ratio. Quick ratio, it's very similar. Okay, we're gonna switch over to the balance sheet on the left because a quick ratio, I'm gonna tell it to you real quick, is current assets minus inventories divided by current liabilities. Current assets minus inventory. That part of parentheses divided by current liabilities. Divided by current liabilities. I know I always have to like slow myself down because I am the person that took statistics in college for fun. It was not required, but I just wanted to take it. Yeah. My friend Roberta thought I was crazy. All right. So does anyone know why we might want to take inventory out of the equation when we're doing this? Because this is essentially the same equation as the current ratio, right? We're just removing inventories from that equation. Does anyone know why, or the value of inventory? Does anyone know why we might do that? Depreciation. Depreciation? Not necessarily, possibly.
Still sell it.
Liquidate. Yeah, you can sell it. You can't sell it, but how quickly can you sell it? Right? Can you sell it right now? How liquid is it, right? If we're talking about liquidity, you have cash sitting in a checking account. I can go down there and get that cash tomorrow. That's super, super liquid, right? If we have stocks, I would have to sell them to get cash. If I have inventory, I have to sell the inventory to get cash, right? But we are all familiar with what are called liquidation sales, right? Everything must go because those businesses are trying desperately to offload that inventory. There's also a seasonality factor to this as well, right? If we have seasonal inventory, after Christmas, there's going to be massive sales on all this Christmas stock that they don't want to pay to store. They're going to liquidate that stock. So your inventory it has debatable liquidity. Okay, so that's why we might take that out. So let's see what that looks like. I'm going to do a couple of equations here. So 480,000 is total assets, but 300,000 of that is long-term. So that's not current. We're not going to look at that. So we're going to look at 180,000. 180,000 of our current assets minus that 110,000 of inventory. And then our total, remember our current is accounts payable, the notes payable is going to be a long term, right? So we're going to take that divided by the 20,000. That's even better. That's a 3.5. That's amazing. That's a fabulous number. Okay, so generally speaking, a 1 is good here, right? If you have enough like cash in your checking account to pay all of your current liabilities today, not counting inventory, then a 1 is good. We're gonna see that as like, we can meet the obligations, right? If you have less than 1, it means you can't meet those obligations tomorrow. And that doesn't count inventory. The reason that a 1 is good here and not like a 1.5 or a higher number is because we're not counting inventory. We know you can sell that. We just don't know how quickly or at what kind of a profit, right? You can turn around and turn that into money. Even if you have to have a liquidation sale and mark it down, 50% off, everything must go, you can still turn that into cash pretty quick. And so that's why a 1 is going to be good here. Okay, so those are 2 ways that we can evaluate this. Third one I'm going to talk about is a debt to equity ratio. So it's the debt to equity ratio. And it is your total liabilities, including short and long-term, current and long-term liabilities. Total liabilities divided by total equity. Okay. So your debt to equity ratio is how much of this company I own. So if we talked about it last time in the Bookkeeping 201, your equity is kind of like, people think the easiest way to describe that is the equity you have in the home. The amount of that house that you own, that's your equity in the home. The amount of your mortgage is the amount you owe. Similar idea here. The equity is the amount of that business that you fully own, that you have like, that's mine. And then owed is the amount of that business that you still owe. So a lower ratio is viewed more favorably here. So let's take a look at the one on the right. Our equity at the end of 2013 is 118,000. And our total liabilities is 282,000. And so that's a 0.4. That's great. This is in a way somewhat like a credit score, right? You can think of this, the higher the number is, the better, right? So 0.4, you have a credit score of 400. This is not a good credit score. If we were at 0.75, you have a credit score of 750. It's an oversimplified way of thinking about this, but it's a really good place to start, right? So the more equity you have versus the liabilities, the better. Okay, and that is a big number that's used. That ratio is often used when you're trying to get a loan, when you want to get a loan. Right. So for a sole proprietor and single member LLC, we talked about what was missing from the income statement is your owner's draw. You're paying yourself. This is where that comes into play. Owner's equity, this is where you're paying yourself, because these 2 samples are actually corporations and not single member LLCs or sole proprietors. It doesn't show up the same way on this, but that common stock line, that would be owner's distribution. That's how much money you're paying yourself out of the business. Okay, that's where that shows up. Okay, so now we've gone over our income statement. And we've gone over our balance sheet and we've gotten some really good information. But what's our cash flow look like? Where is the cash? How much money do we have in the bank? Did either of these tell us how much money is sitting in the bank? Not really. Kind of on the balance sheet a little bit, yes, because that cash and cash equivalents should be your total bank account, but how is that changing over time? So we're going to move on and look at our statement of cash flows or cash flow statement. Either way, right? So actually, if you want to pull out the first page of your handout, I'm going to show you how. So the top, yep, so this one. So this will be on the next slideshow, but the top of this is your income statement, the middle is your balance sheet, and the bottom is your statement of cash flows. And you see those orange lines, those are going to connect the activity on your income statement to your cash flow, and the activity on your balance sheet to your cash flow. Okay, so that shows you how those numbers all connect and why you're gonna need the cash flow statement to really round out this picture of what's going on in your business. Okay, we'll go over that in a little more detail in a minute. But one of the most common reasons businesses fail is poor cash flow. Flat out, a business can be profitable. You can have a profitable business, have terrible cash flow and go out of business. Because it's mismanagement of the cash, because you're not getting a really good visual of it just using the income statement, okay? So the statement of cash flows is critical to seeing how much capital your business has, how much cash your business has to operate. But it's the least used and quite honestly, probably the least understood of all of the financial statements. How many of you have ever heard of a statement of cash flows before today? Okay, good, yes, that's awesome, I love that. So one quick reminder as we get into the cash flow statement, one of the big purposes of the cash flow statement is if you are using accrual method bookkeeping, which most businesses should, then a cash flow statement is going to put like real dollar numbers to those transactions, right? Because the transactions that we're seeing are not necessarily dollars that are moving, they're promissory. Okay, so does everyone understand the difference between cash and accrual and bookkeeping? We talked about it last time, but not everyone was here, you know?
Yeah.
Right, yeah. You're doing accrual? Yeah, I love that. I love hearing that. So I have a bookkeeping mentor in my network who says that accrual bookkeeping prevents fraud. And it actually does, because when you have cash, when you're just moving cash, it's a lot easier to budge and hide, and things don't always come to the forefront. So accrual bookkeeping is a really, really good thing to do. And it definitely avoid fraud. Cash flow statement is always going to be presented in accrual. And it's going to bring things into like, these are the dollars that we're working with, right?
And what was the name of the other?
The cash method, cash, yeah. So just a quick reminder, the cash method of bookkeeping is when the money moves, we record the transaction. Yeah, you're right. So if you pay something in the month of October, so say that you made a purchase in September and they issued you an invoice and then you pay it in October, you record that transaction in October because that's when the money moved, right? Accrual basis is I purchased this in September. I have a bill that is due. That bill shows up on the books as an expense in September. And then that money moves into the accounts payable. And then when I pay it, it's not reported as an expense because I recorded it as an expense in September. So it's when the transaction occurs rather than when the money moves is the accrual method. Okay. It's a little funky because it's theoretical, right? It's statistical. Theoretical. It's pretend money, which is I wouldn't have money over here.
Where does it get slippery? Where does it get slippery?
That is above my pay grade. Like I haven't even done research on how to explain fraud. Honestly, it's interesting because when I was in my 20s, my older daughter's father, his ex, got arrested for embezzling like $20,000 from a restaurant where she worked. And like I told you, I've been booking my whole life. I love this. This is my jam. And I was like, how? How does one even embezzle money? I don't necessarily understand like how, like I can't wrap my mind around it. It happens all the time. Very common.
Happened to us twice. We embezzled from twice, and it was even so the federal government saw it and waived fees and penalties, but the state hung us in Florida, and we had nothing to do with it.
How did that happen in the books? Can you
So we
explain?
don't know.
You don't
So
know.
we had a bookkeeper, and even the bank said the money just disappeared. So we don't know if the bank was in on it. Like we just don't know what happened to $80,000. Just disappeared. We were making deposits. We thought we were paying bills. A contract, one of our vendors came to us, took them to lunch. I like to make sure everything was always paid at the end of the year, so every year was started fresh. And he handed me $21,000 in concrete bills that I thought were paid. And so we went over the books and stuff, and the bank was just like, well, we see the deposits, we don't know where the money went. It's like, no, where's the minus? Like, you had to have taken it out. And there was just no way, it went through, like, say, even the federal government was like, yeah, you've been embezzled from.
Oh,
And the state was like, yeah, we don't know what happened.
Like 40
you're
years ago.
responsible. Yeah, it was about 40 years. ago. Yeah.
see, it's a little harder back then because the software wasn't where it is now, and the tracking wasn't where, you know, like if money goes out of the bank, then it's not as easy, like so trackable now, right? I often tell, and there's certain industries where you have to, obviously, right? But working in cash as a business is a terrible idea. Work in electronic money as much as possible because you track that. And 40 years ago, it was not as much, a little harder to do it back then. You paper checks and stuff, you know, but if you, and obviously some businesses, you have to take cash, right? If you did co-op, you guys take cash from your customers, that's not a big deal, but there needs to be some kind of accountability of like, we have $500 in the cash drawer at all times, at the end of the shift, we count it out, we keep 500 in, the rest goes to the deposit, it's being tracked, and then when it goes from the deposit bag to the bank, then there's a deposit there, and there's gonna be, you know, a short over to a certain amount, but those are all procedures that need to be put in place. I actually worked somewhere over in the Met How that did not have these cash tracking, like they didn't have sales receipts for sales from the store. There was just money that came in, and I was like, oh, you need to have sales receipts so that you know how much money you're supposed to have and how much money you've got. And I did that, and the store manager quit. Very yeah. So that will just tell you, like, when you put these policies in place and people are like, oh, I'm out, you know, it's like, well, yeah, okay, that it tells me everything.
Solve that problem,
right? We had one of my clients recently had an employee who took advances out of the till. Wow. And you're not tracking that.
You guys don't know, say.
Anyways, the employee did get let go, they were terminated, but being in that how it was all very under the table and nobody talks about it, and she very quickly jumped on a job somewhere else, and I'm like, you know, like it's confidential, there is confidentiality. But at the same time, I'm like, you know, they're basically ripping off the company.
Well, they do, a lot of times, the girl that did it just the second time,
Mhm.
she had already done it 3 other times. And they knew that, but the only thing they ever got her for was arson the second time. Because she was caught burning down the building that she had embezzled from to destroy the records. And they knew she did it, but they couldn't prove it. Just like with us, we had deposit slips, but no money in the bank. You know, it was weird. It's like, so it's weird how they can't even catch them sometimes when they know they did it.
So this goes back to, in today's day and age, we have really good software, right? Make use of the software, but also if you're not looking at that software, so when your concrete guy said you owe us, you know, $20,000 for all this work that we did, and you're like, but I thought that was paid. If you had been looking at an accounts payable register month over month over month, then you would see that those bills were.
Sure, it came down to trust.
Yeah.
We trusted our accountant and our bookkeeper.
Most people do. As a bookkeeper, I provide monthly reports for all of my clients, and I highly encourage them to go over those reports. They don't most of the time. I'm gonna be honest, it drives me nuts. Please look at your reports. And I'm not blaming
No,
you,
right,
but
that's-
I mean, it's shit happens, right?
Right,
It's life, and that's the way it's gonna work.
Yeah.
Yep.
But this is going to be one thing that is gonna help you prevent that kind of stuff, right? This is a very positive way of making sure that you're doing what you can. Sometimes it still gets missed. Sometimes, you know, because your bookkeeper could be
Especially if they're
reporting
really good at it,
that
yeah.
you're paying the
Right.
concrete
They're
person.
paying themselves instead of
Right,
paying
on
others.
the check, in the books, it says the check went to the concrete
Yeah.
person, but the check didn't actually go to the concrete person. You're not gonna see that.
It could have looked like it was.
Well, and that was trust too. He trusted us and our company, and when the checks weren't good, and he would call, the secretary would intercept and say, well, you know, Mr. Sophia, been not doing well, and they're just like, you know what,
It's right,
don't even,
yeah.
don't even tell him I called, it's fine. I know he'll be good, don't even tell him.
Oh, I know.
Because there's so much trust.
Did
They
you
just-
have for a year and you didn't even know, and she was.
Yeah, right, that's how you were, it was my grandfather, yeah, and then, yeah, they just,
Yeah.
when it was like this, none of this is true.
Yeah,
And so
it's
it was a mess.
hard. Man, I'm so sorry. You should do that. Anyways, we're gonna go back to, let's get back on track, but there are a lot of different ways for fraud to happen. Accrual is not the end all be all of catching it, but it is one way. It's another filter that you can use. Okay. All right, so we went over, let's see where I'm at.
This matches those.
Yeah. Hang on, we're gonna go to that in the next slide. Oh, yeah, you know what? Let's just do that right now. Let me go over this real quick. So cash flow from operating activities is essentially your income statement, right? Those are the cash receipts, your sales. You paid money to suppliers that you owed them. You paid money to your employees that you owed them. This, because it's a corporation, is gonna show income taxes paid. I'm gonna tell you right now, if you are a single member LLC or a sole proprietor, your income taxes are not a business deductible expense. That is a personal expense. You can pay them out of your business account.
Why'd you just say?
If you are a sole proprietorship or a single member LLC, your income taxes are not a business expense. You cannot deduct them from your taxes. You cannot deduct your taxes from your taxes.
Yeah.
Yeah. So so technically, and I do have a lot of business owners do this, they will pay and make their quarterly tax payments from their business account. It gets put into the books as an owner's draw. It's an owner's distribution, right? Because that's your personal responsibility. It's a single member LLC is a pass-through organization. It is not, it becomes really funky. And I think we talked about business structures in the last one, where it's, for some legal purposes, it's a separate entity, but then when you go to file your taxes with the IRS, they're like, yeah, it's not separate, it's just you. So that's why. Anyway, so that's that top one, right? So income taxes paid, that's because this is a corporation's statement of cash flows. Corporation is going to have separate taxes. There is a point at which you should incorporate. That's another one, that's one to talk to your tax preparer about. If you're a single member LLC, when you hit a certain amount of profit, totally incorporate, because you're gonna save a ton of money on the Social Security and Medicare. Those self-employment taxes are gonna, instead of being doubled and non-deductible, you're gonna be able to deduct them. So that's something to talk to your tax preparer about. However, cash flow from investing activities. This is essentially talking about your assets. I spent money to purchase an asset. An asset is not going to show up on your income statement. It will show up on your balance sheet, but if you're spending cash on it, it's not on your income statement because it does not affect your profitability. Here's another common issue I see is that people think at the end of the year, oh, I have all of this income in my business. I'm gonna go buy a piece of equipment and that's gonna reduce my income so I won't owe as much taxes. Doesn't work like that. Buying equipment, you are buying an asset. You are exchanging a short-term asset of cash for a long-term asset of equipment, but it is still an asset. Okay, whether it's a liquid asset or a less liquid asset, it's an asset. And the IRS does not see that as an expense of your business. There is a rule about how much, is it 25? It's a capitalization rule. I don't have it memorized off the top of my head. Again, talk to your tax preparer. But there is a point at which if you spend more than, let's say it is $2,500, then that becomes an asset and you cannot expense that in a single year. That's where depreciation comes into the picture because you're going to expense the depreciation on the asset, the entire asset in a single year. Okay. So investing activities is going to figure out how much cash occurred in purchasing a non-liquid asset. Okay, how much cash went out. Cash flow from financing activities is typically your liabilities. I took a loan of $250,000 and I spent $210,000 purchasing this piece of equipment, right? So that's money that came into your business. That's cash that came in and then cash that went out, right? And then if you're paying dividends paid to shareholders, owners distributions, right? If you're a single member LLC, think of owners distributions. That's how much money you made, $25,000, which is not much for that year. Anyways, and then at the bottom, you have your net increase in cash. Most cash flow statements and the examples we get to later are going to show, is it really almost 11 o'clock?
Not a cost out.
That has not been reset. Okay. 4 minutes, there's so much to go over. That net increase in cash, that's the change. Most cash flow statements are going to show this is your bank balance at the bottom of it. Like this is the amount of cash that you have. Okay. All right. Let's play with numbers and play spot the red flag, because these examples that we have are going to be, these are some real life examples. Okay, so let's do this real quick. Okay, so at the top, your income statement for 2012, you had net income, net earnings of $2,474. That's going to drop down to your cash flow statement. This is cash that came into your business. This is the total amount of cash that came into your business in this time frame. Okay, so that's going to start your cash flow statement. And when we're looking at the balance sheet, your cash, 181,210, that's your bank balance. I have this much cash in the bank, in the cash or at the register, in checking, savings, very liquid assets, right? That's going to drop down to the closing cash balance of your cash flow statement. Okay, so that's how those interact with each other. Does that make sense? Let's do real life examples. Sample company D. Profit and loss for January to December 22. These are real companies. They have been anonymized for anonymous purposes. We've removed all identifying information. All right. So this one is a hefty income statement. It is 3 pages, just to give you a heads up. Let's kind of go through little by little. At the top, the income. Can anyone point out the red flags in the income? I give you a hint.
Rebates and incentives are income, right? They're expensive. The rebate? Oh, it's
Yeah.
rebated back to the company,
Right.
sorry.
Yeah. Well, yes, that's kind of a red flag, because did you actually sell anything?
Right,
It's a
that's,
rebate.
yeah, it's a rebate. So
Yeah, so that should go in other income at the very bottom of our profit and loss, where we have non-operating, right? So we have other income and other expenses that are not operating expenses. That's where that should go. So yeah, that's a red flag. It's not the biggest issue in the world, but it's definitely something, right?
Is that a lot of uncategorized things?
Oh, it's a huge
Yeah,
amount.
right. Yeah,
Just.
What the hell is uncategorized income? Do we know what a categorized income is?
And you can have uncategorized.
Yeah, you totally can. That's actually, this is from QuickBooks. That is an account in QuickBooks that you cannot delete.
in there.
And it's helpful from a bookkeeping perspective. Because I have software, a client portal that I use for my clients, that if I have income that I see, they make a deposit to the bank, and I'm like, what do you do with that? Cool, what is that?
Yeah.
Like, what, you know, like, so I will put it as a bookkeeper, I will categorize that as uncategorized income. That goes over to my client portal, and my client portal is where I ask questions on direct transactions. It is a secure portal, so I can have actual financial data in the portal. The client has a dedicated login, and they can go and it will show them, this is the date, this is the bank account, this is the amount. What the heck is it? Yeah, and so that is useful for me, but it shouldn't stay there. And also it should hopefully never be almost $1.4 million.
Like a placeholder for a while.
I have.
Yeah.
Yeah.
Did you?
Totally, yeah, absolutely.
Yeah.
Ask them, where'd this money come from? Or what did you spend on here? You know, Amazon, the bane of my existence. So Amazon is like, it's the big question mark. What did you buy from Amazon? Is that a business expense, or did you use your business card for a personal expense?
Yeah.
And is that because, like you said before, the government doesn't care what you made the money on as long as you pay the tax? So this is for your personal information. The government's like, yeah, but you're gonna include it.
Yeah, it's
Yeah.
still
I don't care where
considered
you got
income.
it, you're gonna include it. If you don't care where you got it, we don't care where you got it.
Pretty much, yeah, pretty much. That is a simplification. When we get into, let's say you get audited, then the government's gonna care where that came from.
Gotcha.
Overall, most of the time, they're gonna be like, I don't know, whatever, as long as you include it all, we don't really care. But this can be a red flag for an audit, and you would get tagged for an audit because you didn't tell us where that income came from. How do we know you're not laundering money for the
Yeah.
law?
Right.
You know, like, Wait, is that a legitimate product or service that you're providing, or are you just laundering? Because that's how laundering money happens, is uncategorized income, stuff like that. Or inflated dollar amounts on things. So there is some truth to like, no, the government doesn't really care that much as long as you report it all, but they do kind of care sometimes in certain situations, so. I always have to add the caveat. Also, this unapplied cash payment income is a negative number. Why do you have negative income? That's not a thing. Actually, it is a thing sometimes if you're doing returns and discounts. So that can be a thing if you have a returns or a discount and you want to see those separately in your income, you can do that. And that would be a legitimate reason for a negative. Unapplied cash payment income usually means that you invoiced a customer, but they paid you before you invoiced them. So if I invoiced a customer on today, November 16th, 17th, if I invoiced them today, but they paid me on November 1st, from November 1st to November 16th, your bookkeeping software is like, what is this income? It's unapplied cash payment income. I don't know what it is. And then you put the invoice in on the 17th and it's like, yes, that's what it is. Right? This is when it crosses from one month to the next. I guess October 31st would have been a better example, right? Because if they paid me in October and I didn't invoice them until November, then when I ran October reports, it's going to be this. But this is negative. So there's more going on here. It could be a products and services thing. We're not going to go into the details. I just kind of wanted to get you looking at like some of the uncategorized income, the unapplied cash payment, the rebates and incentives. These things really shouldn't be on your income, right? Okay, moving on to cost of goods sold. We have red flags. Anyone? I'll give you a hint, they're all negative numbers.
Yeah. Why, yeah.
How is that a thing? That's not a thing. You can't have, so, and this is where it gets a little funky, right? Because cost of goods sold is subtracted from your total income. But if you subtract a negative number, you add the number. Okay, it gets that negative positive numbers thing that throws so many people off, gets really wonky. So this is probably they're receiving income from a client for parts and equipment. So say, for example, that I create an invoice, and on that invoice, I am billing the customer for equipment rental necessary to complete the job I just did for them. And then in that product, I code that product to go to a cost of goods sold rather than to an income account. It's going to be a negative cost of goods sold. Okay, so that's probably what's happening here. But the red flag, and this is just, I want you as a business owner to be able to look at it and be like, this is a red flag, I need to research this. And oftentimes, or sometimes, you might want to pull in a bookkeeper or an accountant, pull in a professional, dig into these, have them do a cleanup on your books, and then you have clean books going forward. But this is a red flag of like, something's wrong. This is not what it should be. The one that I love here is this other job-related costs for $225,000 almost. Yeah, that makes sense to me. That's a totally logical. Other job-related costs is kind of vague. I'd like to see a little more detail there, but that makes sense, right? This is a definite, this is a cost of goods sold. There are job-related costs. Okay. So just FYI that's what's happening there. Okay, so moving down into our expenses, we're gonna look at advertising is about 65,000. Okay, cool, works for me. Auto, gas, GPS, payments. Auto payments as an expense. Anyone have thoughts on that? Okay, when you're making a payment on a car, you're paying a loan, right? You're paying a liability. This is not an expense, it's a liability. And so what this business was doing is instead of decreasing the liability, the loan that they owe, they were categorizing that payment as an expense. And that's not actually accurate. That is a method of tax fraud.
Makes one number look. Yeah.
You're claiming an expense that isn't actually an expense.
Even if the vehicle is used for business.
You can claim vehicle use, you can claim your gas, you can claim your repairs and maintenance. If the business is owned, if the vehicle is owned by the business, you can claim all those expenses. But paying the loan,
Not the loan. It's not.
you're paying a lender. You're paying back money that you borrowed. That's not an expense. That's a liability account, okay? So that's, to me, and that one's a little bit harder to see to kind of a layperson. It's like, and this is a really common thing that I see, and what I'm gonna tell you right now is most of the time I see this, they don't know. They just don't know. Business owners oftentimes, most of what I see, 99% of what I see is not somebody trying to get one over. Is not somebody trying to commit fraud. But I want you to understand this from the IRS side, because the IRS is gonna look at that and say, you're committing fraud. And you're like, wait, what?
I paid, how do you expect?
Because it's not the intent that's bad, it's just lack of knowledge. And lack of knowledge can get you in a lot of hot water, unfortunately. All right, so that's the payments. Registration and fees, totally legitimate expense, because you have to pay that every single year. You gotta register your vehicles, right? Repair and maintenance, legitimate expense. You gotta keep that, you gotta get your oil changes, get new tires, whatever it is. Under repair and maintenance, you're gonna see this subcategory CBD 2560 John. That's a specific vehicle. This is for the business's information, right? We're gonna track what repair and maintenance we're spending on each individual vehicle, because we want to know how much that vehicle is costing to maintain. Because when it gets old enough and it costs more to maintain than it's worth, then we're going to sell it and get a newer one or whatever it is, right? That's not something that needs to be tracked by the IRS. The IRS is just going to say repairs and maintenance of all the vehicles. That level of detail is for us as the business owner. Okay, moving on. Bad debts. You can write off bad debts as an expense. Okay, this is a legitimate thing. If somebody does not pay you what they owe you, you can write it off as an expense. Talk to your tax preparer about details on that. Okay. Bank charges and fees, $60,000. Red flags, anyone?
Yeah.
What the hell is going on there? That is just something that I would want to research. And as a business owner, dig into that, research the heck out of that. Okay.
It might be their credit card processing.
That's a lot of, well, yeah, even at 2.4 million, that's a lot. We should, credit card processors, we should be at 3%. I can't do that math in my head. I don't know, maybe it's right,
Yeah, that
actually.
might be.
Yeah, that might be
Yeah.
60,
We're paying over-
You can just put that separate.
that might be, all right, contributions and donations. Are you allowed to make charitable contributions for your business? Yeah, totally, absolutely, do it. I see a lot of people do this to environmental causes, to support the, healthy environment, clean air, that kind of stuff. A lot of people will donate to nonprofits out of their business. I actually have one client who does a percentage of every single, and it goes through her credit card processor, and it goes to environmental causes. Totally allowed, you get to do that. Caveat. If it's, talk to your tax preparer about specific nuance in charitable contributions. I'm gonna leave it there, okay. Dues and subscriptions. And this is one that I see a lot of confusion, and this can be just, this is kind of back to the bookkeeping 101. Your dues and subscriptions are things like your Chamber of Commerce membership. If you're a member of a professional organization, I belong to the Digital Bookkeepers Association, that is a due and subscription. Your software as a service costs are not dues and subscriptions. They are office expenses, software expenses. Okay, that's just me being a little nitpicky on that. Okay. Exterminator, Infinite Enterprise Gas, I see no issues there. Insurance, totally legitimate. This is clearly not a Washington State company because they have separate workers' comp insurance. Interest paid is in an expense other than, and not other income. That's not that big of a deal. Interest paid, if it's a legitimate interest on that those auto payments we were making, that can go under your operating expenses. That's more whether you want to see it there or not and how much interest you actually have. Okay, so I'm not going to stress over that one. Job supplies, fine. Labor, negative $765,000. How is that a thing? How are we making money on labor? It's not. That needs research. Labor, I would also look at why is it its own category there and not under payroll expenses. Labor should be under payroll, right? Most companies, if you have payroll, you're going to have wages and salaries as a subcategory of payroll. You're going to have your employer taxes as a subcategory of payroll. All those things are going to be payroll expenses. You pay, Gusto, OnPay, ADP to process your payroll. That's going to be under payroll expenses. Labor by itself up here, when they also have a payroll category down below, is a red flag. And the fact that it's a negative number is a red flag because that's not right. Okay. Landscaping. Okay, cool. Like if you really are that worried about your plants, like that's fine. Legal and professional services. Quick note about legal and professional services. I like to have this as a separate category because most of the time, your legal and professional services, you are going to be required to give them a 1099 at the end of the year.
Okay, sure.
1099s are for service-based contractors that you use in your business. If you work with me in Ginger Snap Bookkeeping, you want to give Ginger Snap Bookkeeping a 1099 at the end of the year. Any subcontractors, I see this a lot with construction companies. You're a construction company, you subcontract out for somebody to come in and do concrete, you're going to give them a 1099 at the end of the year. You hire a lawyer, you're going to give them a 1099. Here's a fun one. You pay rent on a building. You owe a 1099 for the rent that you pay. That's the one that I see a lot of people don't know. Okay, so be careful with your 1099s. And that's just going to get really, really fun this year because the IRS decided that separate third-party processors need to send the 1099s and not you. Do you get what that means? Okay. So say you use a credit card. I use my Citibank Costco card to pay my lawyer. Citibank sends the lawyer the 1099, not me, because it ran through a credit card, a third-party processor. Okay, some of those are relatively easy, right? So like if I write my lawyer a check, that's me, I have to send a 1099. If I swipe my credit card, the credit card company sends a 1099. Venmo.
You said that, yeah.
Third-party processor. Okay, Zelle is not a third-party processor. Zelle is a direct bank-to-bank transfer. Zelle is fine, use it in your business, I'm happy. Venmo, please, for the love of God, don't use Venmo in your business. It is problematic, despite the fact that Venmo now has business accounts separate from personal accounts. Here's a fun thing. I have somebody in my network of people who uses a cat sitter. And they paid their cat sitter from their personal Venmo to the cat sitter's personal Venmo, and they put cat sitter in the description on the Venmo. And Venmo sent their cat sitter and saying, oh, we're going to send you a 1099. Despite the fact that it is personal to personal Venmo, Venmo is going to send a 1099 to that cat sitter for that income. Technically, the income is taxable and not advising that you pay tax. But let's be real, we all kind of have these people in our lives, right? Like this is not unusual. to have somebody that we pay on occasion at city. That goes over $600, 1099. So just be aware that there are some really sticky things happening this year. It used to be 20,000 was the limit for a third-party processor to spend that 1099. Now it's 600, same as any other 1099.
$600.
$600 is the threshold. Yeah, I should have said that. I assume you know, I should let you know. If you spend $600 on a contractor or a service provider, that is the threshold at which you must provide them with a 1099. I'm gonna tell you right up gate, not all of my clients sent me a 1099. My 1099 services, 1099, yeah. They are not included in my regular monthly retainer with my clients, and so that's a separate service. I had clients who did not do 1099s last year. I still reported the income. That's on me
What
to
happened?
report the income. If you get caught, there are some pretty steep penalties on this. And that's a big if. I mean, you might not.
Yeah,
That's,
well, it's kind of like, yeah, get caught doing 80.
and I think one of the biggest issues is, so for me as someone who receives 1099s, I track my income separately outside of that. And so I don't rely on 1099s to report my income at the end of the year. Okay, I report all my income out of that. If I did not report all of my income and then somebody submitted 1099s late and they added up those 1099s and my income was less than what the 1099 said it was, I could be in trouble. Okay, it's essentially a way of keeping people honest. So. That legal and professional services, meals and entertainment. Yes, meals and entertainment are deductible, meals at 50% right now. There was a couple of years during COVID where they said that meals were deductible at 100% because they wanted to incentivize people to go to restaurants. We are now back to the 50%, meals are deductible at 50%. However, as a sole proprietor, single member LLC, meals and entertainment, if it is excessively large, is a red flag for an audit. I once did a presentation on how do I avoid getting audited. And meals and entertainment being high is a red flag. Okay, so just be aware of that. Another one, and we talked about this in Bookkeeping 101, is the commingling of business and personal funds. If there's a lot of commingling of business and personal funds, that's another red flag for an audit. So that's one of the reasons I say make sure keep it separate. All right, moving on. Medical expenses, office supplies, this all seems very reasonable, right? Other business expenses. 215,000. I'm like, it's a little vague. I'd like some detail on what that is. That's gonna be really hard for your tax preparer. If you give this to your tax preparer and it says $215,000 in other business expenses, the tax preparer doesn't know where to write that on the tax return. Where is that deducted? So it could be fully legitimate. I want more detail. Payroll expenses, 401k, employer match, totally fair. Bonus, commissions, yes. Contractors. Is that contractors or is that salaries and wages? So that's something to be aware of. Contractors potentially could be a cost of goods sold. If we're talking about that construction company again that hires the concrete people to come out, that's cost of goods sold. I cannot complete this job until that concrete's. Okay, that's cost of goods sold. And so that would go under cost of goods sold. Contractors also 1099able. So just something to, as you're looking over, these are the things you're going to want to kind of be aware of. Employee payroll, there it is. There's my wages and salaries. And wages and salaries is my preferred description in QuickBooks 5. Health insurance expense, administrative fees, payroll tax expenses. That's how much you owe in taxes. Your employees' hourly wages, not the amount of money they cost you. Okay, purchases, cash on hand. What? So what this is set up incorrectly. Cash on hand is essentially a bank. This is the cash. So I love using the co-op as an example because it's got a good mix of cash, right? The Tanasky co-op has cash in the store that they need to make change from and such. That's cash on hand, and essentially, the way that's treated in the books is as a bank account. And so if you're taking $3,000 out of the bank so that you can replenish the cash, seems a little high to me, but whatever, you do you. Then you want to do a transfer from one bank account to another, not a withdrawal to an expense account. So again, this is, to me, this says, this is just a business owner doing their own books and not. Okay, we should probably move faster. This is on me. Reimbursable expenses, really big. 450, whatever. Taxes and licenses, this all makes sense. Sales tax. One quick note here, taxes and licenses, when they talk about sales tax most frequently is a liability, not an expense. So that's something that you should be aware of. If you are selling a product and you are charging, you know, let's just say for ACE 10% sales tax. I sell a $100 product. I add $10 to that for sales tax. That's $110 I collect from the customer. $100 goes into my net sales. $10 gets put into a liability account because I owe that to the state. That's not my money. It never was. It never will be. Okay, so that's a little iffy up there.
They should start a different account for them. Their sales tax.
Yeah, it should be on the balance sheet, the liability account. Yeah, so this is straight expenses. And this is why this gets wonky, because like you have that $10 cash in your bank,
Yeah.
but it's not yours. And so that's how the statement of
Can't
cash
be
goes.
added to the profits. Never was yours.
Right,
Hopefully, my books, like I go to Square. That's not-
it should, if you're doing it through Square, there's an integration between Square and QuickBooks. Square has a decent integration. I'm not unhappy with that integration. But definitely because there's a lot of these, there's Square, there's Stripe, there's, you know, all sorts of payroll processes.
Also, Stripe with Amazon or Stripe with my GoDaddy account.
Got great, GoDaddy's another one,
And PayPal.
Shopkeep, PayPal, all sorts of stuff. PayPal is decent for business, just make sure that you're using an actual PayPal business account and not a PayPal personal. Okay, they're one of the better ones because they're old school and those new, they haven't gotten their shit together yet. Okay. Eventually Venmo may be fine for business. Right now, I don't recommend that, it's a mess. But yeah, just be aware. So the integrations, when you are setting up the way that your payroll, that your payment processor connects to your bookkeeping software, you just need to make sure that it's mapping things properly so that the sales goes to sales, the tax goes to tax, etc. So that has to do with how the two softwares communicate. And that can be a little tricky at times. All right. Travel is fine. Uncategorized expense of $578,000. Nope. Again, I use uncategorized expense so I can ask my clients what the hell they spend money on. It should not stay on the books longer than a couple weeks. Okay, and 578,000 is, I'm guessing, more than a couple weeks. All right. Utilities, fine. We're gonna just skip over, other expenses, reconciliation discrepancies. I just want to point out reconciliation discrepancies are not a thing.
Okay.
Okay, reconciliation discrepancies is like opening balance equity. It is massive pet peeve of mine. It tells me nothing. It tells me that you got lazy and wrote off $7,000 worth of money because you couldn't figure it out, you know? Like, figure it out and put it where it belongs. If it's bad debt, put it to bad debt, you know? Like, don't just make it go away.
I just wanted to balance. Put it in there, make it work.
Square peg and that's a round hole. So, all right, does anyone have questions about that? Only about 20 million, I don't understand. I know, it's a lot. All right, sample company A, I wanted to include this because this is going to be your horizontal analysis. What we just did in the previous profit and loss income statement was a vertical analysis, top to bottom. We're gonna go side to side. We're gonna look at trends. We're gonna look at how things change over time. Okay, so we've got January through June, and then a total in the right-hand column. So this is a good 6 months of data. This is really good information. If you flip to the next page, I included the next one too, sample company A, it's January through June of 23 through January through June of 22. And I talked about this a little bit earlier, that due to the seasonality of our area geographically, we may want to look year over year instead of month over month. So that's why I included this second one, so you can see, you know, growth from one year to the next. Instead of just month to month it's a good way to make sure that, you know, like if I need to cut labor, cut back on people's hours or something, or if I need to slow down on ordering supplies, month to month is a really good way to see the seasonality of it. Year to year is a good way to see the growth of the business overall. Okay, so just real quick on that. Sales of product income. Cool, that 100% works for me. I have no issue with that whatsoever. I might want more detail just to give you a little more detail about how your business is, but that's totally fine, right? So if we look, this company has a loss in February and in June. Here's another benefit of accrual bookkeeping. Technically, this says that it's been done in accrual basis, but I question that. Just because the report is set up for accrual basis doesn't mean the transactions have been entered in a way that makes sense to accrual basis. Okay, so when we look at that, the reason I say that is your income for March is almost twice as much as it was for February. And I'm looking at this through a, you know, like Eastern Washington seasonality trend. I'm like, March is not that busy. That's just me living in the mud house saying, no, that's not what we're doing in March, April, and May. June, okay, that would make sense to me. But again, this is knowing your industry, knowing your area, that kind of stuff. Questioning, you know, what's going on. Maybe for this company that does make sense. I don't know. Then we look at things like computer hosting. You want to see that that's in the same ballpark month over month. There's a huge drop in June. So if we see computer hosting is 9,000, 9,000, 88, 10,000, 9,000, then down to 6,000. Yeah, I don't know. It depends on what there's sometimes, and because these are real companies, sometimes I have questions about like, what the heck is that? What do they even mean when they say that? I think company A is a software company. If I am correct, they have farther back they have an internally developed software that they're using. And so computer hosting could legitimately just be storage that they use for that internal software. That's a lot of money to pay for storage every single month. But depending on the industry, that could be very interesting. I pay money for storage every month. It's a virtual world. So yeah, because I do think that this is the one, like they have, if it's the one I'm thinking of, they have a internally developed software that's worth about $250,000. So that could, if you're spending $10,000 a month on hosting that could be. I'm not familiar with that industry. I actually had a client come to me who was a software developer, and I passed him on to somebody who is much better at that industry than I am. I'm like, I could do your books, but I'm not going to be the best person at it. And this guy over here who's totally geeks out on this kind of stuff, he's going to be the one guy you want to talk to, because that's, and I do the same. I talked about this last time. I don't work with nonprofits because it is such a different animal. Some industries, they have such unique nuance that I just am like, I'm going to pass you on to somebody who really, really, really knows. Like, I can do your books. They're going to help you grow your business. Right. You know, like I can meet your lead. Anyways, that's an aside.
What is your area of expertise? Just out of curiosity.
Retail and sales tax. I am the sales tax queen. Which is funny because a lot of bookkeepers hate dealing with sales tax, and I am that giant nerd who I'm like, oh, it's so much fun, I love it. I have experience with sales tax in over 15 different states where I have personally filed The only one I hate with passion is Colorado. I'm like, you can be destination-based, location-dependent sales tax all day long as you're not Colorado, I'm cool. Colorado is their mess. And then after Wayfair, which was the Supreme Court state that said that even if I'm based in Washington State, like I may have to pay sales tax in Idaho or whatever, California. I may have to collect sales tax on behalf of the state government as a seller in that state. That was the Wayfair decision, and Wayfair was like, oh, but it'll be simple. I bet on how simple that is. Yeah. So anyway, so sales tax is my thing. I love it. I have a lot of fun with it. Washington State is very, I don't know how many of you are familiar with Washington State sales tax is destination based, which means that, so here in Okanagan, if I make a sale and this is my home base, but I sell to somebody in Omak and I deliver that product to them in Omak instead of them coming to me to pick it up, I charge Omak sales tax, not Okanagan sales tax, okay? And destination based is so specific that I can literally be across the street and have a different sales tax rate. Depends on where the line is, right? So it's very specific. Also, it could be the same sales tax rate, but I might have to report that under two different codes. Sounds like a lot.
So I got a question.
I kind of,
That's good, I love it.
Yeah.
That's great.
So what if I pay sales tax on the highest rate sales tax like Seattle? Break them down each. I sell online, so I sell online. So I want to break down so we can, which are all those. If I just pay the higher sales tax rate, the taxes, that would come back. I mean, if you're paying more, you shouldn't come back.
well, you're paying more, but who are you paying it to?
Who are you charging?
Well, I mean, yes, there's
Five
that, the
percent.
charging, no, you're paying also 6.5% of the state. So what's the other 4%? Or 3.5 or however much that area of Seattle is. Because, so here's a great example for Twist, because I'm familiar with Twist, right? So your sales tax rate is made up of state, county, and city rates. So your state is 6.5%. County is 1%, I forget exactly how much. Twist is 8.7 is the total, right? So it's charging 2.2% more on top of the state. So that when you submit your sales tax filing to the state of Washington and you say, I sold this much in Twist, the state keeps that 6.5% and they send the rest to Okanagan County and to Twist. So if you're reporting that all of those sales happen in Seattle, yeah, you're taking the highest tax amount, but instead of sending Twist there 2.2 or 1.2% or whatever, you're sending that to Seattle, and Twist is going to get this.
So I really do
You
need
sold
to-
it here, right?
Yeah.
See, that's just on my own.
And again, depending on your software might be able to track that for you. They should, and this is one of the biggest challenges, and I have a California-based client who has some really funky sales tax in Shopify. And so there's a lot of work that I have to do at the end of every quarter to do the filings. But that's where you need to look very carefully at the platform that you're using to make the sale and how they're calculating sales tax. Because the platform is going to calculate it for you. Now, if you make a sale to California or Idaho or wherever else, I'm not saying Oregon or Montana because they don't have sales tax, right? So that's a moot point. Unless you make at least like $100,000 in sales, state dependent, you don't have to collect sales tax for that state. So I'm assuming that you're not making $100,000 in sales to the state of California. You don't have to collect sales tax if the person you're shipping to is in California. You don't have to. Okay.
Yeah, that's more fair, yeah, because I sell, actually online, I sell quite, in some years I sell to every state.
Yeah.
Oh, wow.
And that's called Nexus. If you hit, it's depending on the state, again, it's state dependent. Some states say to $100,000. Some states, I think California, Texas, and New York are 500,000 at this point. So quote me on that. It's been a while since I looked. Some of them are based on the number of transactions you have to a certain state. Alaska, fun fact, does not have state sales tax, but they do have some city sales tax. And there's a city in Alaska that's trying to claim that if you ship to that city, you have to collect sales tax for that city. And I was like, no. No, as a city, you can't claim that. That's a state-based thing, you know, but that was a fun one that we dealt with. I dealt with that when I was working for a lawyer. I was like, no, we're not collecting sales tax.
That's
But yeah,
very much.
there's a lot of nuance. Anyways, okay, let's move on. So our net operating income for sample company A from January to June, 24,000, then we have a negative. So that's where you want to dig in and see why, right? Like, why is that so much lower? Because computer expenses, let's look at that one. Computer expenses in January was $2,200. In February, it's $14,000. That might have been an expected increase, because then it's 11,000 in March, 13,000 in April. It stays relatively high for a few months. So that could have been a very strategic business move that they made to grow the company, and they were willing to take a loss for that month. They also had this massive increase in March that maybe they were building up for that March increase. But these are the types of things that we want to look at to say, you know, like, why is this number so drastically different from one month to the next? Is this something that we saw coming? Is this something that we planned for? Or is this, you know, like mismanagement, fraud, something, I don't know. But we want to flag those kinds of trends over time. It goes back down in June to that computer expenses about 8,000 in June. So maybe it kind of leveled off after 4 months of investment. But that's, as a bookkeeper, that is something that I would look at and flag to the business owner and be like, okay, I'm seeing that this is happening. Is this something you expected? Is this a strategic change that you made? You know, like I have one company that she's a virtual assistant, fully virtual based, and she's growing. So she hired some employees and her cost of labor skyrocketed 1 month because she took herself out of the day-to-day work, hired contractors to do that work for her so that she could then build more clients, a client base, right? But the immediate impact of that is all of a sudden her cost of labor goes way up and her profit goes way down. And I was like, hey, what's going on here? This is a strange trend. This is something I've not seen before. And she's like, yeah, because I stepped out of the day-to-day so that I can then build my time. And I was like, okay, that makes sense, right? So there's legitimate reasons for a lot of this stuff, but we just have to be looking at, you know, like, why are those things changing? Right? Any questions on any of this? Anything that you see that I'm not seeing that?
I wonder why their insurance, they don't pay insurance in April. Or legal professional fees in April, they do.
Skip around.
So this,
Skip around, yeah.
yeah, here's a really good way of saying that, oh, what did I think I do. Yeah, okay. I don't know how to go backwards. Okay, we're good. I didn't stay caught up on this. My bad for those who are watching this later. This is a great example. So say these taxes and licenses is another one in March. That's almost $5,000 and none of the other ones. Taxes and licenses, that makes sense, right?
Oh,
You're
yeah.
gonna pay that once a year. But in accrual-based bookkeeping, what you should do, so say that I pay, you know, $5,000 for my business license, I am going to call that a prepaid expense. And that's an asset to my company. I paid for a year of that. So I'm going to put that into prepaid expenses as an asset. And then every month, I'm going to move a 1/12 of that from that prepaid expense asset account over to the expense account. I'm going to expense it equally throughout the year. This is proper accrual bookkeeping. So if I pay insurance every month, easy peasy, that's a monthly expense. If I pay it yearly because they're going to give me a 10% discount on that, then I'm going to call that a prepaid expense. And I keep a separate spreadsheet for my clients in this, where I have a list of all their prepaid expenses. And I put in a journal entry once a month that's going to show this is the amount of this annual. I paid the whole thing already, right? But I paid it in advance. And this is the monthly amount. And what that does is it helps even out those, right? even out those ebbs and flows and shows me, gives me a better view of the month-to-month profitability. Because yeah, I paid that, like $5,000 in insurance or what have you in 1 month, and that's gonna show my profitability went way down, but that's not really true because that gives me 12 months of services. Okay, so that's what I mean when I say that these reports are prepared in accrual basis. You will see at the bottom, it says accrual basis. But my bet is that whoever's doing these books isn't actually doing it. Well, I know they're not, because I can tell you right here based on this information, that they're not doing it.
Did you say you're moving it to one account after?
You're moving it
From
from
prepaid?
prepaid to whatever the appropriate, so for
Oh.
insurance, I move it to
Sure,
the insurance account,
okay.
right?
That's a.
It depends on what it is. Prepaid expenses is kind of what's the word? Oh, my ADHD. It's like conglomerate is what I'm trying to think. That's not the right word. It's like a bulk kind of account. You can put all sorts of stuff in prepaid expenses. These are my assets, and then when they turn into expenses, it goes, whether it's a contract. If I paid a lawyer, a retainer, and I paid it for an entire year at once, then that's gonna be every month, there's a certain amount that goes in legal expenses, there's a certain amount that goes in insurance and what have you. So yeah, and dues and subscriptions is another one that can help with it, right? Like if I pay for the Chamber of Commerce, then that's a year membership to the Chamber of Commerce or to another professional organization. When it's like, that's for a year of services within that organization, that can be put into a prepaid
There could be
expenses
quite a
asset
few
account.
prepaid.
Yeah, lots of them. And that can really add up, and that can really make a difference. Because, and it doesn't on this one, because that $5,000 taxes and licenses hits in their biggest profitable month. But some of the other ones, like employee benefits too, like if you're doing employee benefits, is that like what does that mean specifically? If that's benefits as, like health insurance or dental insurance or something, then that should be a month to month. And if you're paying in advance, then you're gonna want to even that out with that expensive. That one's a weird one to do that way. Legal professional fees. That one kind of depends. Because if you pay a lawyer for a single, like event or for a project that they're doing for you, that's kind of different than if you have one. Anyways. Any other questions, comments? Okay. So the next one is year over year. And you can look at this. What I love about this is you're gonna have that percent change on the right hand side. Okay, so your net income in 22 was $56,000. Your net income in 23 is $182,000. Woohoo! I love that. It's 6 months, right? But here's where the percentage comes in handy. You had a 40% increase in income with only a 13, almost 14% increase in advertising. You're getting more bang for your buck with the advertising. Or you're seeing the delayed returns on investment of advertising, right? Your computer expenses increased by 40%. That's the same as your profit, the sales of your product, right? So that, depending on what computer expenses, again, these are not my clients. So when I said these are real companies, they are real companies, but not my companies. That 40% might be right in line with the 40% increase in profit, right? Those might be directly related. And then we have some decreases, right? Our data service went down by 7%. Cool. Our employee benefit went up by 55%. That's higher than our 40% increase in profit. Are we just more profitable? So we are going to spend more of that on our employees because they're kicking ass and we love them and we want to reward them? Probably. Like that doesn't bother me. This insurance, 124% increase in insurance. That one I would look at a little closer. Why? What more insurance do we need? Insurance.
I'll tell you,
It could be that.
just with the Chamber of Commerce, our insurance for one parade went up almost $2,000 last year.
Ooh.
But, yes, they got
One
looking at the
parade.
bill, like, wait a second, I talked to our insurance, well, yeah, interest is gone, rates are dangerous. I said, yeah, but last year was 400, this year it's like $1,500, $2,000. Well, and then we ended up doing, she said, well, you can just do a event insurance for that day, for us to buy and have, and that's like $400. I said, well, don't you do it that way? By the time we caught that, we got a big, so, I mean, insurance should be cheap, I mean, we're not that.
Way. Is there was a little girl, 7 or 8 years old, who got killed in that parade back east. You guys heard about that last year? That might be due to that.
But see, I can
That was
see
big
why,
news.
because people are throwing candy out.
Yeah, in
It's
the
right
road.
in the street.
Yeah, she was in the
Horses,
parade and
horses in the
yeah,
parade,
she got run over by a vehicle that was behind it. It was horrible. I'm
Yeah.
sorry. I don't mean to bring it up, but
No, no,
but that's like, when you have stuff like that happens, the entire industry is going to react
That's what she was saying.
to that kind of stuff, you know, like, so you have one person that, you know, a tragic accident happens. And all of a sudden, the entire industry is paying, you know, 200% more in insurance.
I see insurance.
Yeah,
Yeah,
so, okay, so maybe that's legit, right? That could be fully legit, but I would look at it. Here's one, your meals and entertainment went up by 40%. Do you really need to spend that much more? Because that's a red flag category.
Right.
So know what your red flag categories are and watch the rule more closely. Okay. Here's 371%. Your repair and maintenance went up by 371%. What the heck? So this is where the percentages, right? Having this percentage change comes in handy, so we can kind of, you know, flag some of these and go, I wonder why that is. That could be legitimate. Maybe there were some things that really needed to be fixed, which didn't have the money when you only made $56,000. But now that you're making 182, you're like, woo, we're gonna get all these things fixed. You know, all those housing projects that you've been wanting to, I really wanted to update the kitchen, but I couldn't until I got the money, you know, and they finally updated the proverbial kitchen, you know, so they could be very, very legit. You just want to look at them. And net operating income overall is up 223% with only a 40% increase in profit. That's the bottom line. You know, so I would want to look, oh wait, operating expense, sorry, my bad. Go back, total expenses. That's where I want to go. Total expenses are up 27% and your net or gross profit is up by 40%. So that to me overall is okay. That's your net operating income, which is essentially the same as your net income, right? That's because there is no, oh, there's 1 penny in reconciliation.
Yeah.
Whatever. 1 cent in reconciliation discrepancies isn't worth my time. It's immaterial. I'm not going to look at it. So, looking at the trends, looking at year over year, looking at, you know, like how much did my profit increase versus my operating expenses increase? Hopefully, your profit increase is greater than your operating expenses because you're wanting to leverage and become more efficient over time with that stuff. All right, I am going to have to talk over time because we are just now getting to the balance sheet. We may not go over all of these examples. I put a lot in here, but I'm doing a lot of detail. So our second example is a balance sheet as at the end of 22. So let's just kind of look at this again. I looked at all of these before, but I'm looking at them again. So our current accounts, we have our banking accounts, checking, savings, 2 savings accounts, 2 checking accounts, PayPal Bank, and PayPal Hold. Can anyone tell me why those bank accounts? So those are, it can. So those are what I refer to as clearing accounts. PayPal you can have a balance in PayPal. You don't necessarily need to track it depending on how frequently that transfers over your bank account, right? I know some people who do daily transfers, some do weekly transfers. If you want to see it that frequently, then you can connect it and, you know, and be showing it here as cash that you just hasn't been deposited into your bank account. It depends. But PayPal business account at least is going to be charging fees as well. So they're not going to deposit the full amount. So you're going to need somehow to recognize the income that PayPal didn't put in your bank account.
So they don't put it in and take it out, like.
Some do and some don't. Honestly, I'm not 100% sure about PayPal. From my experience with PayPal, they withhold that money. And then there's other ones like, I work with a hotel that rents rooms through Airbnb. Airbnb holds that money back. And so that is legitimate sales income, but it never hit your bank account. But you have to recognize that because you owe taxes on that, right? That's income. And that can add up depending, it's just, I say no matter how small you are, if it's $5 a month, recognize the income. Because at $5 a month, it's not enough to matter, right? But if you're in that habit, then when it's $500 a month and all of a sudden it is material, you're in the habit of doing it. You have a process in place for doing it. Okay. So the clearing accounts a lot of times will really help with that process. So the balances in here are 0, as they should be at the end of any reporting period, because you've done all of the reconciling transactions and put the money where it's supposed to be. But that's why they're gonna show up on here, is probably because that's what they'll be used for. That's my first guess. So your total liquid cash assets are $206,000. And then you have $100 or $1,100 in accounts receivable. So that's what people owe you as of the end of 22. Oh, look, here's a prepaid expenses account. We were just talking about that. That makes me so happy to see it on here. Current assets, prepaid expenses, right now it's 0 because maybe you pay them in January and then at the end of the year, it's all gone. You should install that, yeah. Well, it depends on what time of year you pay it, right? Because like some of my software comes up in July and some of it you know, whenever. It depends on when I added it to my company. So, undeposited funds, does everyone understand what that is? Yeah. Mostly, yeah, it's like if you get written a paper check.
Oh.
Okay, yeah.
I gave you a check, but it's not in the bank. It's just holding, it can be cash too. If you are a business that's operating in cash, I highly recommend you have a cash, you know, like a cash drawer account as a bank account on here. If you are not a company that operates in cash, don't take cash. Or if you take cash, it would be an undeposited fund. But don't.
So you're saying if you do take cash, you should have it as it's better, you have to just have it. Would you have
Cash on
separate,
hand.
would you do two, like if you have two separate drawers, would you combine them as one or?
In your books, you can combine them as one, but then I would recommend that you have, because if you have 2 separate drawers, you likely have 2 separate employees. And there's a certain level of accountability that needs to happen unless you have multiple employees operating the same cash register to say that happens. So it becomes, what you're doing is you're limiting the exposure or the risk. Because if you have 10 different people and all 10 people have their canned hands in the same cash drawer all day long, one of those people pulls $100 out, right? Listen. I mean, I hate to think this way because it's such a cynical way to think, but you have to.
So yes, I think a lot, but yes, I need separate.
And the other thing is, you know, like I have some crafters, some craft companies who are operating farmers markets and they take workshop farmers markets. Although even that is not as much these days because they've all got the like little square plug-in for their phone and they just swipe the card in their phone or whatever. But still, there is cash that exchange hands. Just keep really good records. Just track it really well. Okay, so and those are internal controls that don't necessarily need to show up on the bookkeeping software. But you should have some kind of internal controls. Okay. All right. Prepaid expenses, undeposited funds, fixed assets. So we just did our current assets, right? Short-term assets. Now we're doing long-term assets. We have a Volkswagen. The Volkswagen is worth, this is the value, not the cash. This $18,844. Think of this as your blue book value. This has nothing to do with how much cash is invested in this vehicle. This is how much it's worth, theoretically, if you sold it to them. Which is always, you know, like never really is what it is, right? But this is the book value of it. Okay, then we go down to our liabilities, current liabilities, short-term stuff. Credit cards are short-term, right? We've got American Express, we've got a bunch of credit cards, total credit cards. We owe $1,300. I don't see a problem with that. That looks pretty good. Other current liabilities. Look at that. zeros. I love that. That makes me happy. Federal unemployment, $9.40, they owe $42. Okay, that's fine. Sales tax payable, 0 at the end of the month. Cool, you paid the state your sales tax that you collected. Total current liabilities, $63.80. Long-term liabilities, look at this, we owe Sunnyvale Volkswagen for that Volkswagen we saw in our assets, right? This is the loan. So we owe $9,400 on a Volkswagen that is worth $18,000. Okay, so in that previous income statement, when we saw vehicle payments, this 9,400, this is where you should see vehicle payments change the balance. So your vehicle payments should go against this, reducing this $9,400. Okay, so it should show up in the balance sheet, not on the income statement.
We would expect that car value to change next year as it depreciates. That fixed asset would be lower next year.
So yes, so there is not on this statement, there is not an accumulated depreciation category, but there should be. So absolutely, because that depreciation is what you're gonna write off on your taxes as an expense. You do get to expense a fixed asset over the life of the asset. So if you expect this vehicle to last, so you have $18,000 vehicle, let's just round that number off. And you expect it to last you for 10 years, you can put $1,800 in depreciation every single year. And there should be a category, we call it a contra account, where it's going to reduce it. So you'll see accumulated depreciation, negative 1,800 or whatever the balance happens to be, and that will reduce the total value of that asset. Yes, 100%. Good catch. All right. Talitha's major pet peeve, opening balance equity. That's not a thing. Please don't use it. Owner's investment, money that you put into your business or purchases that you make for your business with your personal money. Sometimes this happens, you know, like I used a personal credit card to buy this thing that's actually for the business. Or this could be goods, right? Or like I had this laptop, personally owned it, that I'm going to contribute to the business. That's a contribution of the value of the laptop. Okay, that's another way to do that. Owners pay and personal expenses, $180,000 this year. That's pretty hefty. I would love to hit that number. Retained earnings from last year, $218,000. That's previous year's carryover, right? Retained earnings is just kind of a big account that at the end of the year, your bookkeeper, accountant, or tax preparer should be putting records in your books to move all of the equity over to your retained earnings, so you're starting with fresh zero equity at the beginning of every year. Okay, so that's what retained earnings is going to be. That's the whole totality of last year's. Net income for this year, $173,000, and then we have our total liabilities and equity. So let's do. Well, do you guys want to play with numbers? I'm gonna let you play with numbers. It's 11:03 according to my watch, so we're out of time. We can look over a statement of cash flows real quick, a more complicated one if you want. Or I can let you go because we are at time. You tell me what it looks like. The very last page of the entire handout is a statement of cash flows. Is everyone good to go over it? Okay. Let's go over it. I did give you the equations. If you want, you know what, I'll ask Nathan to, I have email addresses on the sheet. Okay, I will take a picture of that sheet before I leave. I will make sure that you get a copy of the slides, which I have not caught up with at all.
Hard to juggle all that.
Okay, we're just gonna go down, right? I know. I'll make sure that you will get a copy of the slideshow. And then I will write out those equations for you. I saw you frantically scribbling notes, but I'm going to put it in the email as well, just so you have it. Okay. All right, so here's our sample company B statement of cash flows. Net income, they're at a loss. That's a net loss, actually. That's not $35,000 loss, okay. Adjustments to reconcile net income to net cash provided by operations. It's a really long-winded way of saying these are all the things that changed. Right? Accounts receivable. We collected $32,000 from customers who owed us money. So because this is a cash statement, this is showing the movement of cash. So every single one of these numbers is cash dollars that actually moved hands, right? So accounts receivable means that those people paid us that money. Accounts payable, we received, I would say this is most likely situation where we received like $300 worth of inventory or something that we did not have to spend that money on. Okay, so. And this is where cash dollars gets a little funky. We should have spent $300 on that. But because we didn't, we get to increase our cash in our bank by $300 because we bought it on account.
That happens to them, sometimes they'll get a truck where there'll be extra supplies and they won't take it back, they leave it at the store, but it didn't cost the store anything. And they have the right to sell it, right, so that box of chips or whatever would they go into that category, right, which we didn't pay for it, but we have the right to sell it.
Yeah, that's an interesting. That's an interesting thought because that's not, you don't have to pay it later, it's just.
So.
They're,
They write it
I
off.
don't know what they do with it, they do it
Oh,
like
during
throw it in the
COVID,
refrigerator.
Oh, it's
Yeah.
amazing.
They throw it in the
Back during COVID, they were like, hands off, we
Yeah.
are not touching anything.
Yeah.
Like, oh, that's too funny. Yeah, I'm trying to think because there has to be a balancing side, right?
Right.
Double entry.
Yeah.
So you have an increase to inventory, but what's the other side of that equation?
Yeah,
Right.
Right?
Yeah.
I would say,
Confusion.
yeah.
So that's
So-
not that number, that's not.
No, that's not that number. It would, that would increase your inventory on the balance sheet. And then,
Yeah.
That's weird.
yeah. How we, like, how we would increase that? My brain is trying to blank. It might be.
I don't know, it's like a donation from them or something. Yeah, usually we did. That's usually what we did. We usually divvied it up between the employees. And
Well,
whatever
yeah,
they
if the
did.
employees take it home, then it's just like, it's,
Yeah.
you know, it doesn't.
Most of
make
us,
it
we just know what else to do with it at that point, you know.
But I'm trying to figure out, like, that's an interesting one for me, because I cannot for the life of me right now.
Yeah.
It'll come to me tomorrow and I'll be like, oh, that's, well, obviously.
Yeah,
that's
we
what
were
you
like,
should've done
was
with
it a donation from them? They gave it to us and we don't have any, yeah, it was weird,
Well, on their side, I'll tell you what's happening is that they're counting it as a loss.
Right,
Right,
just straight
it
up
just
loss.
shows it a loss, it's kind of a write-up as bad debt or a loss, or shrinkage is a term that we
Yeah,
use,
okay,
you know, that's the kind of stuff that we do. And so they're just like, it's a write-off, whatever, it's not worth it.
Yeah.
But for the person who receives that, that's not something I've actually. Okay, so tonight, when I'm laying in bed listening to my meditation to go to sleep, it's gonna pop up and I'm gonna think of you. I'm like, oh. And then I will email you. That's a funky.
Yeah, yeah, it's good.
All right,
We're all gonna.
I know, right? I'll just include it in the email.
Email.
So, let's see, now moving on to, okay, so all of the credit cards, we had balances on the credit cards and we used cash to pay down those balances. Essentially. We got a loan from the LLC. That must be somehow connected, this business owner must have more than one. We got a loan from one to the other of 26, so that's cash into the business. Okay, investing activities. So these are improvements to assets. I spent cash. So when we look at this 124 Coolidge, that's a building, right? We know that that's an address. If we're renting it and we make substantial changes to the value or to the building, even if we're renting it, that can be an asset of their leasehold improvements, right? I'm leasing it, but I'm putting value into this, and that can be considered an asset. That gets a little funky, so we have to care on that one. Mostly, I don't see people in that situation. They either own the building or they rent the building. If they rent the building, they're not gonna put that much, right? That's those kind of improvements are like permanent improvements. It's not like, you know, buying furniture that you can take with you,
Like putting a roof on it.
yeah, right, exactly. So I think your family should do, but anyway. Also, we spent $183,000 to buy a cargo trailer. That was a really cheap trailer, but that's the cash that we got. If you look down a little farther, loan, white cargo trailer financing. Oh, look. Lisa, how we paid off that much? Oh, that's interesting. Okay, those are both minuses. So it looks like maybe that was, maybe we replaced the hitch on the trailer, right? When you have an asset and you make a change to that asset that extends the life of the asset, that's an increase to the asset value. Rather than just standard maintenance, right? So if you have a trailer and you've got new wheels for the trailer, that's expected, that's standard maintenance, you're gonna replace the wheels, that's an expense.
Like we put a compressor in our walk-in, it cost us $15,000 to
That is a substantial improvement to the life of the walk-in, right? So that asset is going to last you an extra 5 years because you replaced the compressor, right? Like, we hope so. So that is an improvement to the value. So those kinds of things, those are not expensive. So that's gonna show up here in this investing activities, where it's like we extend the life. So I don't know what they extend the life for $185, but we're saying that's cool. Right, and then financing activities, these are payments that I made on loans. I paid another $3,300 on that F-150. I paid another $835 on the cargo trailer, right? Those are reducing the liability, but it's cash out of my bank account. Okay, I did an owner's contribution. This is a positive number. I put $600 of money into the business. And whether that $600 is cash that I deposited to the bank account, or whether that's inventory that I purchased with personal funds that the business would have had to pay that $600, but they didn't. So this is the cash balancing of the activity that happened on the balance sheet, right? So your inventory on the balance sheet increased by, let's say, $600. This is the cash balancing of it to make the cash match to turn accrual into cash dollars. It gets a little funky, but I hope that makes sense. I also took $1,200 cash out because I wanted to buy a bunch of coffee. And then I paid myself owner's pay. Really, owner's draw and owner's pay in this situation is the same thing. If you are a single member LLC being taxed as an S corp, then your owner's pay should go through payroll and it should be expensed. Okay, and then that would show up in your net income because that's where the income statement, the expenses are all already figured into that. Owner's draw, owner's pay in this situation is. And maybe I could see, okay, I could see why an owner might do this. If I want to see that I'm paying myself a consistent amount every single month, right? And so that's why I have that $25,000 because I'm getting X dollars every single month that adds up to that amount. The 1,200 is extra over and above. Right? That's stuff that I don't really, so there might be reasons for keeping those separate. I would put them under a parent situation. Okay. So essentially, right, so we had a $35,000 loss in the business. And if we go down to the bottom, our cash quote increase was negative $58,000. So our cash decreased by another $58,000. Cash at the beginning of the period was $95,000 and we minus that 58. So now at the end of the period is $36,000. So this is where all of the transactions that are like theoretical monopoly money turns into actual cash dollars. That's how this statement of cash flow works. Does anyone have questions on that? So if we watch this month over month over month, we can see that we're not overspending, spending too much, you know, taking too much out of the business as an owner, et cetera, et cetera. We can make sure that money, cash money is being managed properly to fund the activities of business. There is a possibility, I do want to point out real quickly, that you can be cash positive and be losing money as business and not be profitable. Like this one right here. Well, no, that's not cash positive, it's cash negative. Try to think of a situation. So say, for example, your business is not profitable, your business is losing money every month. You're spending more on operating expenses than we're bringing in. But your cash is increasing at the end of every month. Why might that happen? I mean, in accrual basis, that's theoretically possible because the expenses are not actual dollars, they're theoretical dollars. So yes, that's possible. More likely, you're taking on liabilities, you're borrowing money to turn yourself into a cash positive business, okay? So yes, I mean, that's absolutely, that could be the case, but most of the time when I see it happen, it's because they're borrowing money. And that's where we go back to the balance sheet and those fund ratios, because then we can see they're losing money, but they're cash positive. The balance sheet is in between those that tells me why that's happening. Because I'm seeing the liabilities in the balance sheet, I'm seeing them increase month after month. And I'm seeing these ratios looking like, that's not good. You can also be a profitable business and your cash negative, your cash is decreasing every month. This is why businesses fail. You can be profitable and you're losing money every month. Can you want to tell me why? Couple of reasons.
Paying out what's coming in, I don't think.
As an owner, and I see this all the time, because owners don't really understand how profitable their business is, so they pay themselves all month long, all year long, they just give themselves lots of money, and then they don't have any cash in their business to pay their bills because their business bills, because they took it all out for personal expenses. Okay, so that's one reason, and because that's your income statement isn't going to show your owner draws, right? So that's one reason. Another reason could be because you're just buying a bunch of shit.
Sitting on, yeah.
You're buying a ton of inventory and sitting on it. You're buying a bunch of assets that you don't really like, all this equipment that you don't really need. This is where you need to look at, like, yes, I'm a profitable business, and if I buy this piece of equipment, I could be even more profitable. But do I want to spend the cash for it, or do I want to finance it? Because financing is a really, really good choice sometimes. It could absolutely provide you the leverage that you need to move forward. Debt can be leverage to move forward as long as you're balancing that properly. Okay, so that's how it all comes together. Okay, thank you so much for going over with me for about 15 minutes over. I really appreciate your time. Does anyone have any more questions? No, we're good. Okay, good. Hang out, I want to ask any questions. We're gonna call it officially done, but I will hang out for a while. I'm gonna stop the recording and then we can socialize. I just
Can we do a little intro? Just so we know-
oh yes, totally.
Yeah.
Hi, go ahead.
Oh, no, I'm sorry. My name is Jessica Johnson, and